Buying a call option on Apple at $182.50 costs $550 per contract. If Apple moves up $5 over the next 2 weeks, your call might still expire worthless, because Theta has eaten the time value faster than the stock moved. You paid $400 to be right on direction, and you still lost. This is the core problem with single long calls. The break-even is far from the current price. Time decay works against you every day, and the stock has to move significantly just to recover your premium. The bull call spread solves this. It cuts your entry cost by nearly 40%, lowers your break-even dramatically, and keeps your risk completely defined. You still profit from a bullish move. You just do it at a fraction of the cost. In this video, I will show you exactly how to build a bull call spread on Apple, what the numbers look like, and the 3 scenarios that determine your outcome. A bull call spread is a debit spread. You buy one call option at a lower strike and simultaneously sell one call option at a higher strike. Same underlying, same expiry. Buying the lower strike call gives you the right to buy the stock at that price. That is your bullish bet. Selling the higher strike call caps your maximum profit, but pays you a premium that reduces your total entry cost. Because you pay more for the lower strike call than you collect for the higher strike call, you pay a net debit to enter. That net debit is your maximum loss. Your maximum profit is the width of the spread minus the debit paid. Both are defined the moment you enter the trade, before the stock moves a single cent. This is the structural advantage of the bull call spread. You know your worst case and your best case before the market opens. No surprises, no margin calls, no escalating losses. 2 legs. 1 long, 1 short. Leg 1, buy the lower strike call. This is your directional exposure. You own the right to buy the stock at the lower strike. If the stock rises above this strike, your call gains value dollar for dollar above the strike. Theta works against you on this leg. Time decay reduces its value every day the stock does not move. Leg 2, sell the higher strike call. This is your cap and your cost reduction. You collect premium, which directly offsets the cost of leg 1. You give up any profit above the higher strike, but you also lower your break-even and reduce your maximum risk. The sold call's Theta works in your favor. It decays towards 0, and you keep the premium. Net result, a directional trade with a lower entry cost, a lower break-even, and fully defined risk on both sides. No naked exposure. No margin requirement beyond the spread width. Here is the real trade. Apple at $182.50. You are moderately bullish. You expect Apple to move toward the 190 range over the next 45 days. A single long call at the 180 strike costs $5.50. $550 per contract. Instead, you build the bull call spread. Buy the 180 call at $5.50, sell the 190 call at $2. Net debit, $3.50 or $350 per contract. Maximum profit, $10 with minus $3.50 debit, equals $6.50 or $650 per contract. Maximum loss, $3.50, the debit you paid. Break even at expiry. 180 plus $3.50 equals $183.50. Apple needs to move just $1 above its current price for this trade to be profitable at expiry. That is the power of selling the upper strike to fund the lower. On the Tiger Brokers options chain, navigate to the 45-day expiry. Go to the call side. At the 180 strike, bid $5.30, ask $5.70, mid-price $5.50. This is leg 1, buy to open, 1 contract. At the 190 strike, bid $180, ask $2.20, mid-price $2. This is leg 2, sell to open, 1 contract. You execute both legs as a spread order. In Tiger, open the spread order ticket, select bull call spread, enter the 180 and 190 strikes, and enter a limit price of $3.50 debit. The platform shows your net debit, maximum profit, and break even automatically. Always use a limit order on spreads. Never market order a 2-legged position. Apple options are highly liquid. At $3.50 debit, you are buying the spread near mid-price on both legs. A fill at $3.40 to $3.60 is realistic on most trading days. The profit and loss diagram for the bull call spread. Horizontal axis, Apple's price at expiry. Vertical axis, profit or loss in dollars. Starting from the left, below 180, both calls expire worthless and you lose the full $3.50 debit, the flat loss zone at negative $3.50. At 180, maximum loss. Above 180, the spread begins gaining value linearly. Every dollar Apple rises adds $1 per share of value to the spread. At 183.50, you cross zero, break even. Above 183.50, the trade is profitable. As Apple approaches 190, profit ramps toward the maximum. At 190 and above, the spread reaches its full $10 width and your profit is locked at 650. The shape: a flat loss zone on the left, a rising ramp between the strikes, and a flat profit ceiling on the right. Compare this to a single long call, same ramp shape, but starting from a lower floor and no profit ceiling. Maximum profit is locked in at entry. The formula: spread width minus net debit. In this trade, the spread is $10 wide, the distance from the 180 strike to the 190 strike. Net debit paid, $3.50. Maximum profit, 10 minus 350, equals $6.50 per share, or $650 per contract. You achieve maximum profit when Apple closes at or above 190 at expiry. At 190, the long 180 call is worth $10 intrinsic. The short 190 call expires at zero. Spread value, $10. Net result, 10 minus 350 equals 650. Above 190, you give up additional gains because the short 190 call limits your upside to the spread width. That is the explicit trade-off: lower entry cost, lower break-even, capped maximum upside. For a moderate target move, which is what this trade is designed for, the cap never comes into play. Maximum loss is the net debit paid, $3.50 or $350 per contract. You reach maximum loss when Apple closes at or below the 180 strike at expiry. Both calls expire worthless. You paid $3.50 and received nothing in return. That is the entire risk of the trade. There is no scenario where you can lose more than the debit. The short 190 call is fully covered by your long 180 call. You are never naked on the short leg. Compare this to a single long call at $5.50. Your maximum loss is $5.50, 57% more risk. The bull call spread reduces maximum loss by 36% while maintaining a lower break-even than the single call. You are buying time to be right on direction at a meaningfully lower cost. For smaller accounts or traders who want directional exposure without committing full long call premiums, the bull call spread is the standard vehicle. Break-even at expiry is the lower strike plus the net debit. 180 plus 350 equals $183.50. Apple needs to close above 183.50 at expiry for the trade to be profitable. In dollar terms, a $1 move from the current price of 182.50. For context, if you had bought the single long call at 180 for $5.50, your break-even would be 185.50. The bull call spread breaks even $2 lower. That $2 difference is the direct benefit of selling the 190 call to fund part of your entry. Lower break-even means a higher probability of finishing in profit at expiry. The probability framework: 183.50 break-even on Apple currently at 182.50 means the stock needs to move less than 1% to the upside. That is a moderate, realistic target for a 45-day trade. Scenario 1. Apple rallies strongly. 45 days later, Apple moves to $195, a strong $12.50 move from entry. Your long 180 call is worth $15 intrinsic value. Your short 190 call is worth $5. You owe this to the buyer. Spread value at expiry: 15 minus 5 equals $10. You paid $3.50. Profit: 10 minus $3.50 equals $6.50, $650. Maximum profit achieved. Apple moved $12.50. Your spread capped at $6.50. The trade was profitable, but you did not fully participate in the rally above 190. Compare. If you had bought the single long call at $5.50, the same move returns $9.50, 173%. The spread returns 186%. Spread wins on return on risk even on a large move. Absolute dollar gain is higher on the single call, but the spread required 36% less capital. Scenario 2. Apple makes a partial move. 45 days later, Apple trades at $187, above break-even, below the upper strike. Your long 180 call is worth $7 intrinsic. Your short 190 call expires worthless. Apple never reached 190. Spread value: $7. You paid $3.50. Profit: $3.50, $350. A 100% return on the debit paid. This is the sweet spot for bull call spreads, a moderate, realistic move that does not need to reach maximum profit to be highly profitable. At 187, you are $3.50 above break-even and $3 below the upper strike. Any close between 183.50 and 190 at expiry produces a profit between 0 and 6.50. The spread is designed for exactly this outcome. Moderate directional moves that a single long call would struggle to profit from at the same capital cost. Scenario 3. Apple stays flat or drops. Apple moves to $178 at expiry, below the lower strike. Both calls expire worthless. Your long 180 call, no intrinsic value, expires worthless. Your short 190 call, also worthless, no obligation to pay. Loss, $3.50. The full debit paid, $350. This is the clean, expected loss scenario. Nothing to close, nothing to exercise. The spread expires and you absorb the debit. No margin call, no escalating loss, no surprise. The maximum loss was known at entry. Compared to the single long call, the same scenario produces a $550 loss, $550, for the same directional outcome. The spread trader absorbs $200 less when wrong. Over time, across multiple trades, that difference compounds. Being wrong costs less with the spread. That is why directional traders prefer spreads over single calls in most moderate move scenarios. Bull call spread versus single long call. When does each win? The spread wins on a moderate, defined move. If Apple moves from 182.50 to 190, a $7.50 move, the single 180 call returns $4.50 on $5.50 risk, 82%. The bull call spread returns $6.50 on $3.50 risk, 186%. Same move, same direction. The spread wins decisively on return on risk. The single call wins on a large breakout above the upper strike. If Apple moves to 200, the single 180 call returns $14.50, 264%. The spread is capped at $6.50. Choose the spread when your price target falls within the spread width, implied volatility is elevated, and selling the upper strike reduces for cost, or capital efficiency is the priority. Choose the single call when you expect a large breakout move beyond your target, or you want uncapped upside exposure on a high-conviction trade. The complete bull call spread on one page. Underlying, Apple at $182.50. Strategy, bull call spread, moderately bullish, defined risk. Leg 1, buy one Apple 180 call, 45 DTE, at $5.50. Leg 2, sell one Apple 190 call, 45 DTE, at $2. Net debit, $3.50, $350. Spread width, $10. Maximum profit, $6.50, $650, at 190 or above. Maximum loss, $3.50, $350, at 180 or below. Break even at expiry, $183.50. Risk reward, 186% maximum return on risk. Stock needs to move less than 1% to reach break even. Target for maximum profit, 190 or above. Trade management. Consider closing at 80% of maximum profit, 520, if reached before expiry. Do not hold to expiry chasing the last dollar. Here is what you now know and can now do. 1. The bull call spread buys a lower strike call and sells a higher strike call on the same expiry, paying a net debit. 2. Maximum loss is the debit paid. Maximum profit is spread with minus debit, both known before entry. 3. The spread outperforms a single long call on return on risk for moderate, defined moves within the spread width. 4. Use it when you are moderately bullish, when implied volatility is elevated, or when capital efficiency matters more than unlimited upside. 5. Always use limit orders on spread entries. Know your break even before you place the trade, and manage early at 80% of maximum profit. That completes the core option strategy series: covered call, cash secured put, the wheel, protective put, and bull call spread. In the final video, we bring everything together, a risk management framework that maps each strategy to market conditions, so you always know which tool to use and when. That is video 13.